They tell you to check your credit score like it's a heartbeat. Higher is better, lower is danger. Simple, clean, reassuring. Except that's not how it works. Because right now, millions of people are doing everything they were told to do for their credit and quietly paying thousands more than they need to. Higher interest, worse loan terms, missed opportunities, all while believing they're doing great. Here's the uncomfortable truth. Most of what you think you know about credit scores is either outdated, incomplete, or flat out wrong. And the system doesn't rush to correct you because your confusion is profitable. Let me show you how this actually works. Picture two people, same income, same city, same age. One gets a mortgage rate that costs them an extra $280,000 over 30 years. The other doesn't. The difference wasn't hustle, it wasn't discipline, it wasn't being good with money. It was a handful of credit score myths they believed without realizing it. The first myth is the most common one, that your credit score is a single number. You open an app, it says 742. You relax. You think you're done. But that number is a performance, not the system. In reality, you don't have one credit score. You have dozens. Different models, different versions, different rules. Mortgage lenders often use older FICO models. Auto lenders use others. Credit card issuers use newer ones that punish behavior the old models ignore. That excellent score you're proud of, it might not be the score your lender sees at all. Which leads to the second myth, that checking your credit score means you understand your credit. You don't. Because your score is just the output. The inputs are where the damage happens. Utilization, account age, credit mix, inquiry timing, tiny mechanical details that move interest rates far more than people realize. Here's one that costs people real money. The myth that carrying a balance helps your score. It sounds logical. Show activity, prove responsibility. That's what the advice used to say. It's also wrong. Your credit score doesn't reward interest payments. It rewards risk prediction. The system isn't asking, are you responsible? It's asking, how likely are you to miss a payment when things go wrong? Carrying a balance raises utilization. Utilization increases perceived risk. Risk raises your price of money. You're not proving anything. You're volunteering to pay more. Another myth, that closing old credit cards cleans things up. You stop using it, you want to be neat, you close it. Your score drops. Not because you did something irresponsible, but because the system interprets it as fragility. Your available credit shrinks, your utilization jumps, your average account age falls. From the model's perspective, your financial history just got shorter and tighter. That's not stability, that's vulnerability. Now let's talk about the one that does the most damage. The myth that once your score is good enough, the details don't matter. People think there's a finish line, 740, 760, 800, some magic number where the system stops caring. It doesn't. Interest rates don't move in big, dramatic steps. They move in basis points, tiny fractions, quiet differences. But over time, those fractions compound brutally. A 0.5% difference on a mortgage isn't a rounding error, it's 6 figures. The irony is that the people most obsessed with chasing a perfect score often focus on the wrong behaviors, and the people who actually benefit from the system understand something else entirely. Credit scores are not a measure of morality. They are a pricing algorithm. They exist for one reason, to predict default risk at scale. That's it. Not to reward hard work, not to encourage saving, not to help you build wealth, to decide how expensive you are as a borrower. Which brings us to a quieter myth, that credit scores are about your financial health. They're not. Someone living paycheck to paycheck with a perfectly timed payment history can have an elite score. Someone with real assets, cash, and no debt can have a mediocre one. The system doesn't care how safe you are. It cares how predictable you are. That's why people with money often don't play the credit game the way everyone else does. They don't optimize the score, they optimize the cost. They know when a score matters and when it doesn't. Here's the part no one explains clearly. Credit scores matter most right before you borrow, not all the time. Yet people micromanage them constantly, opening accounts they don't need, avoiding strategic moves that would help their real finances, delaying decisions because they're afraid of a temporary dip, a dip that often doesn't matter at all. The system trains you to fear volatility because fear keeps you compliant. And that brings us to the hidden math. Credit scoring models heavily weight recent behavior, not just overall history, which means timing matters more than people realize. Two people with identical credit profiles can get different rates depending on what they did in the last 30 to 90 days. Paying down balances before statements close, spacing out applications, letting accounts age quietly. These are not hacks, they're mechanics. But mechanics don't go viral, myths do. The biggest myth of all is that credit scores are neutral. They're not evil, but they're not neutral. They are optimized for lenders, not borrowers. A system that punishes people for avoiding debt, rewards long-term borrowing behavior, and prices money based on statistical patterns, not individual reality. That doesn't make it broken. It makes it exactly what it was designed to be, which is why understanding it matters more than obsessing over it. If you treat your credit score like a grade, you'll play defense forever. If you treat it like a pricing signal, you start making different decisions. You stop asking, how do I raise this number, and start asking, when does this number actually matter? Sometimes the smartest move is to ignore it. Sometimes it's to protect it aggressively. Sometimes it's to accept a short-term drop to reduce long-term cost. The system doesn't explain that distinction because it doesn't benefit from you seeing it clearly. So here's the question to sit with. How many financial choices have you made to protect a number that wasn't even being used? And how many thousands has that caution quietly cost you? That's not a call to game the system. It's a reminder that the system is already playing a game. The only real decision is whether you understand the rules or just keep following the myths.
If this kind of breakdown is useful, this is exactly what the channel does. No hype, no shortcuts, just how the system actually works. Subscribing just means you won't miss the next one.